Corporate Finance Presentation, Purchase of Stock and Dividend Reinvestment Plan. Get ready, it's time to take our chance with Corporate Finance. Repurchase of stock, which may also be called a buyback, a decision to buy back a company's own shares from the marketplace. So we can imagine a company, they have their shares selling on the secondary marketplace. They go into the marketplace, buy back their own shares from it. The company may do this to increase the value of the stock and improve the financial statements. So in essence, why would they do this, or what would be the effect if they were to do this? Well, they would be decreasing cash because they would be paying cash to buy back the stock. Once they bought back the stock, it would no longer be on the secondary market. There'd be less shares out there outstanding, and therefore the shareholders that are still holding on to the stock have fewer shares out there, and it could increase then the value of the shares that are still on the market. Companies often repurchase shares when they have an excess cash and the stock market is on an upswing. So if a company has excess cash, meaning they have more cash than they really need to be reinvesting into the company in such a way that they can get a return greater than generally the return that the investors could get if you gave the cash back to the investors as dividends. So then you're thinking, well, I want to give value to the owners by giving them this revenue that we've generated, this excess cash that we have at this point, and give value to the owners. Now, then you have to take into consideration tax impact and some other kind of things that take place. If you were to give a dividend, that would be good, but you got to take into consideration the fact that when you distribute the dividend, of course, you could have some impact with taxes at that point in time, the owners being taxed at the dividend. One other option is if you were to purchase back your own stocks, then presumably the value of the other stocks that are out there, now that there's less stocks outstanding, would increase as well. So you can kind of give a benefit to investors in that way, which they may not be actualizing with regards to taxes until they actually sell the stock. So that's another way that you can kind of give benefit. So a stock repurchase can be an alternative to a cash dividend in theory, the benefits being the same under either action. So it would kind of depend on what the shareholders want in terms of whether they would prefer a dividend or whether they prefer this type of action to be taking place. Obviously, a dividend is kind of more straightforward. So when you're dealing with investors that maybe are less, sophisticated, they might just say, hey, I'd like to see a cash return for the excess cash because it's more concrete. But you could have benefits, including possibly tax benefits, if they took some other action like this, increasing the value of the stock in that way. In theory, the two resulting in similar valuations. The benefit of stockholders is that the earnings per share could go up because the number of shares outstanding goes down, which is going to be the idea. If the company buys their own shares back, the number of shares that are currently outstanding on the marketplace goes down. If the number of shares goes down, you would assume then that the value of those shares still on the marketplace would go up. So other reasons for a repurchase may be that they may be used if the market price is too low. So if the market price is below what they think is the optimal level, they might do a repurchase situation, in which case you would assume that the market price might go up. Now, if they did a repurchase in that type of situation, it might be seen as a negative signal by the market. And so that could have a negative impact, but that would be the general idea. There may be used as part of an employee stock options or a tender offer in a merger. It may be used to help protect against the merger in some kind of poison pill type of plan and whatnot. So the Dividend Reinvestment Plan, or the DRIP, so we have a Dividend Reinvestment Plan, a vehicle that lets shareholders reinvest dividends to purchase full or partial shares of stock. So obviously, if the company's giving back out dividends, then if you can take those dividends and reinvest them back into the company, that would increase the cash flow for the company and could be beneficial to everyone involved. So the company benefits from the increase in the cash flow because the dividend, of course, is money that's going from the company to the shareholders. The shareholders go ahead and take that money, reinvest it back in to the company. Then that's going to increase the shares or the cash flow for the company. The company operates the DRIPs, which is the Dividend Reinvestment Plans, are commission-free because no broker is needed to facilitate the sale. That could be, of course, beneficial as well because there's less fees that would be involved. Companies that see it as too costly to directly run their DRIP programs will often turn to third parties or transfer agents who facilitate all the drip details on the company's behalf.